Good morning and welcome to TOITOI Japan Market Radio, coming to you from Tokyo on Thursday, March 12, 2026. I'm your host, and we're here to bring global investors up to speed on what's moving in Japan's equity, currency, and bond markets today. Joining me as always is our portfolio manager with a sharp focus on Japan macro. Let's dive straight into today's session.
Thanks for having me. It's been a risk-off morning across Japanese markets, and we're seeing that reflected clearly in the major indices. The Nikkei 225 closed down 1.04% at 54,452.961, while the TOPIX fell a bit harder, down 1.391% to 3829.0. Smaller caps took an even bigger hit, with the Mothers Index dropping 2.67% to 2442.0. The J-Right Index also declined, down 0.675% to 1987.0. On the currency side, dollar-yen moved higher to 158.876, up 0.482%, which is notable given the broader risk-off tone. We're also seeing crude oil surge 6.636% to 93.04, while gold in yen terms dipped 0.613% to 19,440.0. That oil move is the key story driving sentiment today.
That oil spike is clearly front and center. Before we get into the energy dynamics, let's talk about the yen. We have some fresh commentary from Mitsubishi UFJ suggesting Japanese authorities may actually tolerate further yen weakness given the current geopolitical backdrop, specifically the Iran conflict. That's quite a shift in tone, isn't it?
It really is, and it's an important signal for global investors watching Japan's policy stance. What Mitsubishi UFJ is indicating is that both the Ministry of Finance and the Bank of Japan may be comfortable accepting a weaker yen in the near term, even as we push toward 159 on dollar-yen. Historically, Japanese authorities have been quite sensitive to sharp yen moves, but the current assessment seems to be that with the Iran conflict creating global uncertainty, supporting exporters and maintaining competitive advantage outweighs the usual concerns about import-driven inflation. For Japanese equities, a weaker yen is typically positive for the big export names, autos, machinery, electronics, because their overseas earnings translate back into more yen. On the FX side, this signals that intervention risk is lower than many investors might have assumed, so we could see continued downward pressure on the yen, especially if geopolitical tensions escalate further. And for JGB yields, a tolerated yen decline usually correlates with rising inflation expectations, which would put modest upward pressure on the curve, though safe haven flows could complicate that dynamic.
So if authorities are signaling tolerance for weakness, that removes one of the key downside risks for dollar-yen bulls. Does this change your view on positioning in Japanese equities, particularly in those export-heavy sectors?
It does tilt the risk-reward more favorably for large-cap exporters in the near term. If the yen continues to drift weaker without triggering intervention, we'd expect names in the automotive and industrial machinery space to outperform. That said, we need to balance that against the other major theme today, which is the surge in energy costs. Japan imports virtually all of its crude oil, so higher energy prices are a direct hit to corporate margins and household purchasing power. The interplay between a weaker yen boosting exporters and higher oil crimping profitability is going to be critical in determining the net effect on the Nikkei and TOPIX.
Staying with that energy theme, let's talk about what's happening in crude markets. We're seeing reports this morning that oil prices are threatening triple-digit levels, with futures climbing sharply on Middle East tensions. How should investors be thinking about this move, especially given Japan's heavy reliance on energy imports?
This is a major concern for Japan. The move we're seeing today, crude up 6.636% to 93.04, puts us within striking distance of $100 per barrel. For a country that imports more than 90% of its energy needs, this is a direct hit to the current account and the trade balance. Higher oil prices mean Japan pays more for imports, which worsens the terms of trade and puts downward pressure on the yen, all else equal. On the equity side, the impact is mixed. Trading companies with energy exposure, refiners, and utilities with pricing power can actually benefit from higher energy prices. But the broader manufacturing base, especially chemicals, petrochemicals, and transportation, faces significant margin compression. Consumer discretionary also tends to underperform because higher energy costs eat into household budgets. For JGB yields, the initial reaction is often downward as safe haven flows support bonds, but if higher oil translates into sustained inflation, we'd expect yields to push higher, particularly in the 5 to 10-year part of the curve.
So we're really seeing two forces at work here, the risk-off sentiment from geopolitical tensions, which traditionally supports the yen and JGBs, but also the fundamental pressure from higher energy import costs, which weakens the yen and raises inflation concerns. How do you reconcile those two dynamics?
That's exactly the tension investors need to navigate right now. In the very short term, say the next few sessions, if we see further escalation in the Middle East, safe haven flows will likely dominate, and the yen could strengthen despite Japan's energy vulnerability. But over a longer horizon, if oil remains elevated or moves above 100, the structural pressure from higher import costs will weigh more heavily, and we'd expect yen weakness to reassert itself. The key variable is how sustained this oil rally proves to be. If it's a short-lived geopolitical spike, markets can look through it. If it's the start of a sustained move higher, the Bank of Japan will face a real dilemma, balancing inflation risks against the need to support growth.
And we've got U.S. economic data on tap later today as well, which could add another layer of complexity. How does that fit into your outlook for Japanese markets?
U.S. data is always critical for Japan because it sets the tone for global risk appetite in the dollar. If we get weaker than expected U.S. numbers, that could dampen dollar strength and provide some relief to dollar-yen, at least temporarily. Conversely, if the data comes in strong, it reinforces the view that the Fed will remain restrictive, which supports the dollar and keeps upward pressure on dollar-yen. For Japanese equities, weaker U.S. data would likely weigh on sentiment given Japan's export exposure to the U.S. market. So it's a bit of a double-edged sword. Investors need to watch not just the headline numbers, but also the market's interpretation of what it means for Fed policy and global growth.
Shifting back to equities for a moment, the Mothers Index was down quite sharply today, 2.67%, which is a bigger drop than the mainboard indices. Are you seeing that as a continuation of risk-off sentiment hitting smaller caps harder, or is there something else going on?
It's primarily a risk-off dynamic. Smaller caps and growth names tend to be more volatile and more sensitive to shifts in investor sentiment. When we see oil spiking and geopolitical uncertainty rising, global investors typically rotate out of higher risk segments and into larger, more liquid names. The Mothers Index is also more domestically focused than the Nikkei, so it doesn't get the same boost from yen weakness that the big exporters do. That said, if this risk-off tone persists, we'd expect continued underperformance from small and mid caps until we see some stabilization in energy markets and geopolitical headlines.
Let's pull this all together for our listeners. We've got Japanese authorities potentially tolerating a weaker yen, crude oil threatening to break $100, and global risk sentiment deteriorating on Middle East tensions. What's the key takeaway for global investors with Japan exposure?
The key takeaway is that we're at an inflection point where multiple crosscurrents are converging. The tolerance for yen weakness is constructive for large cap exporters, but rising energy costs are a significant headwind for the broader economy and corporate profitability. If you're positioned in Japan, this is a time to be selective. Favor names with pricing power, strong balance sheets, and export leverage. Be cautious on energy-intensive sectors and domestic consumption plays. On the currency side, the path of least resistance for dollar-yen still looks higher, especially if authorities are stepping back from intervention. And for fixed income, watch the inflation data closely, because if oil stays elevated, the BOJ's ultra-loose stance will come under increasing scrutiny.
Excellent summary. As always, we're not here to give specific buy or sell recommendations, but rather to help you understand the forces shaping Japan's markets. If you're a global investor tracking Japan exposure, or if you're considering adding Japanese assets to your portfolio, make sure you're following these themes closely. We'll be back tomorrow with another update. Thanks for tuning in to TOITOI Japan Market Radio.
Thanks for having me. Talk soon.